Balancing risk-return means to balance your high and low-risk investments appropriately. Let's use a pyramid to show some common financial retail products according to risk-return. The bottom of the pyramid gives the lowest risk-return like a time deposit from the bank, followed by an insurance savings plan. The top of the pyramid has the highest risk-return like a unit trust. Usually, these retail products are suitable for people who are unwilling to actively manage their investments. They would rather accept low returns from banks, pay high commissions to insurance agents, or pay yearly management fees to fund houses. These insurance or investment fund houses would use their money to invest mainly into stocks and bonds. For smart, savvy investors, their pyramid will look like this: ETFs at the bottom, followed by REITs, bonds, and shares. At the top of the pyramid will be investing into startups. Let's start with the basics. Buying a stock, share, or equity means the same thing by owning a piece of the company. You are an owner of the issuing company and gives you the right to vote in shareholder meetings and receive dividends from company earnings if distributed. Historically, stock returns outperform other investments in the long term but carries a higher risk due to price fluctuation. A bond is like an IOU between the lender and borrower. Buying a corporate bond means lending money to a company, while a treasury bond is to lend to sovereign governments to finance projects and operations. Buying real estate investment trusts, or REITs, means owning a piece of the real estate. REIT managers will collect rental income on these properties. It then distributes that income as dividends to shareholders. REITs usually borrow a lot of money from banks to purchase big real estates and sensitive to interest rates like bonds. The most important difference between bonds and REITs is that bonds pay interest or coupon rate usually every 6 months with a maturity date, while REITs have no maturity date. REITs tend to pay rising dividends over time as their cash flow grows and have better capital appreciation potential than most bonds. Buying an exchange-traded fund ETF is like buying a basket of securities that trade on an exchange, just like a stock. ETFs offer low expense ratios and lower brokerage commissions than buying the stocks individually. Let's sum up the advantages of being a savvy investor. First is to have higher potential returns, retire and escape from the rat race at a faster pace. Second is to have more options for investments instead of putting money into the bank to protect against inflation rates. Lastly, they are able to better understand how the world works by learning to own big businesses in company stocks and real estates in REITs. So, be a savvy investor and balance your own risk return with stocks, bonds, REITs, and ETFs. Thank you.
Download the app now.